We're really thrilled that you can join us for this webinar today. We're very excited to discuss why Silicon Valley real estate is a smart investment, and you have an opportunity to ask questions that you have about this unique market. So let's take a look at what we'll be covering today. So I'll be starting off with an introduction to Eric. And after that, let's take a look at the questions that we get asked daily and what real estate investors want to know. And we'll go through the Silicon Valley real estate market, past, present, and future, and talk about why investors should invest in San Jose. And then we'll wrap it up with, walking you through our projects, Urban Catalyst, and what sets us apart. So I'm going to start out by just reminding everyone that at the end of the presentation, we'll be sure to answer your questions. So please make sure to ask your questions using the Zoom Q&A feature, and we'll make sure that all your questions get addressed. So now I would like to start out by introducing Eric. Eric Hayden is our founder of Urban Catalyst. And as you can see here, he has extensive experience in real estate development, with projects that are in excess of $3.5 billion in real estate in the Bay Area, and his extensive relationships with a broad network of property owners to acquire prime investments, and navigating projects through the entitlement process, working with the city officials. He really brings successful, proven track record of success. So without further ado, I will pass it over to Eric.
Hey, thank you so much, Angela. And of course, thank you to everyone who's joining us today. Really looking forward to giving you this presentation and answering all of your questions. I'm happy to be joined today by Tom Tognoli. I'm going to introduce him here in a minute. First, I'm just going to talk a little bit about Urban Catalyst, who we are, and I'm going to talk about some of our projects and really a little bit about downtown San Jose. And Tom, I know I haven't introduced you just yet, but of course, feel free to chime in and chat with me as we go along.
So I'm never afraid to do that, Eric.
Of course. So here at Urban Catalyst, we're a real estate equity company. We're focused on doing ground-up development projects in downtown San Jose, California. We're also an opportunity zone fund, which allows us to give our investors the additional tax benefits associated with the opportunity zone program. Real estate in downtown San Jose has been one of my life's works. And when I formed Urban Catalyst in 2018, my plan was to form a company to do ground up real estate development projects. And to do that, I brought on some partners. My first calls, of course, were Josh Burrows and Paul Ring. I wanted to bring on a team of all-star developers for downtown San Jose. And both Paul and Josh have extensive experience building a variety of different ground up development projects here in the downtown area. Now, of course, we're not just developers, but we're also fund managers. Brought on Morgan Mackles as our head of investor relations. He's the primary reason why here at Urban Catalyst we've raised over $65 million to date. Brought Sean Raft on. Sean does all of our, he manages all of our financial consultants, our accountants, our attorneys, our fund administrators. What I like to say about Sean is he really dots the I's and crosses the T's here at Urban Catalyst. As a group, we have a lot of experience, as I mentioned, doing ground-up development. Here are some examples of some of the projects that we've done throughout our career. I always like looking at, pretty pictures of projects to make sure that everybody gets an idea of the types of buildings we've built. Now, I mentioned we do a lot of projects in downtown San Jose, and of course, the highlight of this webinar is why Silicon Valley real estate is still a smart investment. So let me tell you, from the perspective of a developer, what we want to see whenever we do development anywhere, and how downtown San Jose has all of those attributes. So the first thing that we want to see is we want to see that Silicon Valley, or we want to see that all of the different types of projects that we plan to build in downtown San Jose, that there's a demand for them. And that demand here in downtown San Jose is really driven by the Silicon Valley job engine. Next, we want to see physical infrastructure and transit already in place. I mean, obviously, downtown San Jose is the only true urban environment in all of Silicon Valley, But it also has some great transit features like Diridon Station. Diridon Station is the largest train station on the West Coast. San Jose State University, it's right in the heart of downtown. You really can't talk about downtown without talking about San Jose State. With over 35,000 students and 12,000 faculty members, it's the second largest university in the Bay Area behind Cal Berkeley. San Jose International Airport is the fastest growing airport of any major city in the United States. So that transit and physical infrastructure, that's an important point because, you know, the new generation of tech workers, the millennials, you know, they want experiences. They want to ride their mountain bikes to work on mass transit. They want to be in an urban environment and have this kind of connection. So that's what we want to do when we build projects, is we want to make sure that we're in areas just like this. Finally, and most importantly for us as developers, we want to do business in places where local government wants to see ground-up development happen. Downtown San Jose has really become one of the best places to do development in all of California. Just, they really have a streamlined pre-construction process, and that has been spearheaded by the mayor of San Jose, Sam Liccardo, who is in this picture with my partner Josh and I. Sam was the council member for the downtown area for 8 years, and he's been the mayor for 6 years. And it's been in his tenure that downtown San Jose has become so friendly towards developers. And to give you a little bit more of an understanding of what is happening in downtown San Jose from our perspective, from a real estate perspective, this is a map of downtown. And of course, I'll just point out this black line is the opportunity zone. As an opportunity zone fund, we do all of our business inside of the zone. Here is Urban Catalyst headquarters. We're located right in downtown. This is the Santa Clara Street BART line. So BART, the medium gauge rail system here in the Bay Area, it's been around for over 60 years. Just announced last year, it's fully funded to connect through downtown San Jose and into Diridon Station. This is big news for San Jose, having these types of connections. Also, I always like to point out, Adobe has had their world headquarters here for 27 years, and they're an example of a longtime tech tenant here in downtown. Of course, I mentioned San Jose State earlier, and you can see their proximity to downtown. What is hard to ignore, of course, in this map is Google. Google, in the last 18 months, has purchased $450 million worth of property in downtown San Jose. And that's over 80 acres. The plans they've submitted to the city show that they're going to build 7.5 million square feet of office and 5,500 residential units. At build out, this will be Google's largest campus on earth. And they're expecting, with the supporting jobs that this campus will create, that an additional 100,000 people will be in downtown San Jose every day because of this campus. But it isn't just large tech tenants that have been migrating, you know, southward through Silicon Valley into downtown San Jose, but it's also large developers have come into downtown San Jose. You can see here, this is in orange, developer by the name of Jay Paul. He's a big office developer here in the Bay Area. In the last 8 months, he's purchased $650 million worth of property in downtown San Jose. And his plan is to build 4.5 million square feet of office. He's already broken ground on this 900,000 square foot project and just got his approvals on this larger project 2 weeks ago. So that is all definitely moving forward. And it's just a part of the overall macroeconomics that are happening here in the valley. With that, now I'm going to introduce Tom. Tom is the co-founder of Intero Real Estate Services. He started that in 2002 into one of the best real estate companies in all of Silicon Valley. Of course, he sold it in 2014. He's now a partner of One Flourish Capital. He has a fantastic track record of doing investment as an angel investor, as an advisor, as a real estate developer, and of course, he's a passionate entrepreneur. So, Tom, with that, I'll let you take it away. Tom, I think you're on mute.
There you go. I'm off mute. I was going to say, if you flip the slide, I think There you go. A little bit about One Flourish first, really quickly. So, well, and actually, I'm not sure. Do we have the Intero slide before this one or after? Just go back to the Intero slide for a moment. I thought I would just maybe start with telling you guys just a little bit about who I am with Intero and how all of that came about. So I've been in the real estate industry since I got out of college in 1987. I've lived in Silicon Valley since 1965, long before it was ever called the Silicon Valley. And my family's been in the real estate business, pretty much my entire life. So I've been around real estate forever. And started off as a salesperson in '87. Had many different roles over the years. Ultimately, in 2002, ended up starting Intero Real Estate Services with my partners. We had an angel investor. It was a great fun run. We built that company, really focused in on, which is interesting, a lot of the things that we're focused in on One Flourish Capital, on building an amazing culture. And ultimately, when people ask, how were you able to go from 0 to 20% market share and the #1 real estate company in Silicon Valley in such a short amount of time? What was it that made Intero unique and special? Really what made us unique and special was the people and, was the culture of the company. In 2007, myself and 3 of my partners had this grand idea to buy out our angel investor. We bought our angel investor out in April of 2007. If you actually wanted to pick the worst day to buy a real estate company, that was probably it. But as you often hear, that which does not kill you makes you stronger. We ended up surviving the recession, the Great Recession, which was incredibly difficult. But it put us in a position, and we were poised to come out of that better and stronger than ever before, because people during those times were again looking for, they were looking for leadership and culture and a lot of the things that Intero had provided, because people were just looking for, lack of a better word, safety and comfort. And then we were fortunate enough to get approached by Warren Buffett's Berkshire Hathaway. We sold that company in 2014. And as Eric had pointed out, at the time that we sold, and even still today, close to 20% market share in Silicon Valley. They're doing almost 15,000 transactions a year, 12 billion in annual sales volume. After we sold Intero in 2014, I actually stayed on as president and CEO for 5 years. I stepped down just a little over a year ago, and I've spent really the last year investing in, researching, talking to all sorts of people about business, investment opportunities, from high tech to real estate development, both inside and outside the Bay Area. So, again, the reason I think, Eric asked me to be on today was just because I have pretty much sat in every seat you can possibly sit in the real estate business. So since I left Intero, I was fortunate enough, I had a mentor, a gentleman by the name of Skip Vaccarello, who had been a spiritual, personal, and business mentor of mine, a very successful Silicon Valley executive, multiple-time CEO. He and 3 partners had started a early stage venture capital fund called One Flourish Capital. And I ended up, just again, through all of my research, I made an investment in that firm and ultimately ended up becoming a partner. And so today, I actually wear a lot of hats. I'm a real estate developer, as Eric said. I am an active investor. I'm an advisor for a number of small startup companies in Silicon Valley, as well as, guiding and helping build our fund at One Flourish Capital. Again, which, you can see our mission right here. Again, faith-driven venture capitalists investing in and mentoring early stage tech-enabled fast growth companies led by high character, high capacity entrepreneurs who recognize that culture is critical to success. And again, that's been my personal recipe of success my whole life. Is I think I talked about this with you before, Eric. I wasn't the scholar student. I kind of learned through school of hard knocks. And, I had to kind of pull it up by the bootstraps and really work hard. And so building cultures, building teams is super exciting. And again, that flows into, a lot of the reason why I was so interested in Urban Catalyst, beyond, all of the financial benefits that come with being an investor in Urban Catalyst. It was the culture that they have as a company. And the reputation, again, of people like Eric and people like Josh and Paul and Sean and the whole team, at Urban Catalyst. I got introduced to them through some people in Silicon Valley who I have a tremendous amount of respect for. So ultimately, that's why I was involved there. But as a realtor, even though, I'm not actively buying and selling real estate, anymore myself today, I always get asked the same questions every place I go because I've been in the industry for so long. What do I think about the state of the real estate market? Should I buy? Should I sell? Should I refinance? What's going to happen with the Silicon Valley housing market? You name it, I get asked those questions, and I think the first thing that I tell people is nobody really knows for sure, what's going to happen in the short term. But real estate, unlike a lot of other equities, isn't a short-term investment. It's a long-term investment. And although it can be very difficult at times, you really can't pay attention, in my opinion, to the flows up and down of what's happening in the real estate market in the weeks and months and sometimes even years. Because it's just like a big slow moving ship. As you noticed, barring the Great Recession, the stock market pulled back at the beginning of Corona. I don't even remember what the percentage was, a significant percentage. Whereas again,
I think it was about 30%, Tom, it went down.
Yeah, so the housing market pulled back a little bit as well, but nowhere nearly as drastically as the equity markets. And again, it's not going to come back quite as fast as the equity markets because it's just a little bit of a, like I said, a less sexy, it's a less sexy way to get rich in real estate. So anyway, I think if you're looking at real estate, on a short-term basis, and I do a lot of real estate development, I'm flipping properties, there's a tremendous amount of risk in all of that. And in many ways, it's speculation on my part, but what I like what Urban Catalyst is doing is, again, because it's such a long time horizon, a decade, I don't really care what happens right now in coronavirus. There may be other things that are going to happen over the course of the next several years, that are going to make the markets go up and down. And you just kind of have to not pay attention to it and just focus on the long-term, objective of your investment strategy. And also just look historically, especially when you look at the Bay Area, Silicon Valley, and San Jose. If you go back over time, there have been lots of ups and downs. And like I said, I've been in this since the late 80s. I bought my very first house in October of 1989. Again, I'm not a very good buyer at times, but, I tell people, I bought that house, in October of 1989, and literally was upside down in that house because that was when the earthquake happened, the stock market crash happened, the savings and loan crisis was a mess, but ultimately I ended up selling that home 8 years later for twice what I paid for it. And so again, back to my whole point, if you're in it for the long term, I don't think there's really any other, more stable, solid investment than real estate. And especially when you take into consideration, it's one of the very few investments that we can all make where we can leverage debt comfortably to kind of help us grow that portfolio. So,
Tom, one thing that we hear a lot from our investors and our potential investors is that they're tired of the volatility associated with short-term investments in the stock market, that it's almost like they've been riding a roller coaster, especially here during COVID. And what they're looking to do is to diversify their portfolio into a longer term asset. So I think a lot of our potential investors are thinking along the same lines that you are.
Yeah. And, you know, a lot of my friends that, you know, I know you and I have talked about this before, Eric, and I know part of the reason you guys are doing these webinars is you do have a lot of probably first-time real estate investors. You know, maybe they own their primary residence, but you have a lot of people coming out of high tech, people that, you know, have a significant amount of capital gains, looking at ways to redeploy that capital most efficiently as possible. You know, and so as you guys know, I've referred tons of people to you, and you know, and obviously I'm an investor myself, so you know, it hits the mark on just a number of fronts.
You know, that's absolutely true. Right now, 65% of our investors, we have over 130 investors. 65% of our investors, their capital gains event, and by the way, because I didn't mention it earlier, to get the tax benefits associated with opportunity zone funds, you have to invest capital gains. But 65% of our investors, their capital gains event was the sale of stock. And it was
Right.
a lot of folks here in Silicon Valley. We have executives from a lot of the major tech firms that have invested with us.
Right. And then, you know, you think about, you know, San Jose in the Bay Area, I look at it a lot like, you know, just trying to visualize it. You know, it's like you've got a glass and the population is water, right? The glass is only so big. You can, you know, at some point that glass is going to get full and overflow. And the Silicon Valley is kind of like that. We just have a limited supply of land. You know, we have obviously, you know, we have all the capital, or a significant portion of the capital in the world is coming from Silicon Valley, high tech, and population growth. I mean, when you factor all of those things in, you know, as I've told, you know, I tell everybody, I'm a big believer in the long-term growth of Silicon Valley. You know, and you know, I think it's just a great way, especially, you know, if you're heavily invested in other asset classes and you don't have diversification. You know, candidly, if anything, I'm the other way, right? I'm heavily into the real estate market, and probably maybe I don't have as much in equities as most people do. You know, but it's finding that balance, right? You know, between, you don't want to have 90% of your net worth all tied up into a handful of stocks, or even within a particular industry. I think the diversification that you get with being with you guys makes a lot of sense.
So Tom, we're already getting some questions that I know we're going to talk about, which is, you know, really what's happening because of COVID in the real estate markets. So maybe we should talk about that a little bit.
Yeah, so I'll be surprised. You know, I think like many, you know, I was actually in Switzerland when COVID broke out, and I had to get back early and kind of slid under the tag coming through customs, coming into San Francisco airport. You know, and within that first month, I was probably like everybody else, afraid, you know, like what the heck is going on, you know, and where is all this going to lead, not only for, you know, physical and mental health, but everybody's, you know, personal financial statements as well. And, you know, candidly, surprisingly, you know, as much as the stock market pulled back, I didn't even look at it today, but I know like the S&P 500 was back, you know, up above where it started at in 2020. So I'd be honest, I'm very surprised about that. But back to housing, you know, and just real estate in general, you know, and I talk to people, you know, certainly all over the Bay Area, but even around the country. I'm up in Tahoe right now. You know, the Tahoe real estate market is completely gone bonkers. Everything up here is selling. As a matter of fact, prices in Tahoe are probably more than they were before COVID. Down in the valley, depending upon, you know, where you're located, I often tell people, if you look at, you know, Apple Computer or, you know, Google, Facebook, Adobe, you know, as long as you're close to that mothership, you've noticed that property values haven't been as impacted as much as if you go farther out, right? So, you know, depending upon the markets, you know, I've seen as little as, I said 5%. I've seen deals where houses and, you know, apartments and things are selling now still at record prices. But then I've also seen other markets, you know, that where properties maybe pulled back 10 or 15%, you know, and, you know, just kind of are flatlined there. And as I tell people, unlike the stock market, I don't think you're going to see prices in real estate like rebound 10 or 15% in a month. That's just not how it works. I think we're now at kind of a new normal, and we just kind of grow from here. So, right now there's an incredibly low inventory of housings on the market, especially as you go up the peninsula. It's just incredibly tight up there, and everything is selling across the board. So, from a residential standpoint, there's still just a significant lack of supply, and with monetary policy and everything the Federal Reserve is doing, I don't see that changing anytime soon, personally. On the commercial side of things, all of the naysayers will say like, oh my God, everybody's going to be working from home now, and all of these big corporations are going to get rid of all of their office space. I disagree. Again, back to what I talked about with the way we built Intero and the way we're building One Flourish. It's all around culture. It's around people. It's around relationships. And you can't create those remotely. No matter how hard we try, it's difficult to do it through Zoom. It's difficult. A lot of my best business ideas, people I've met have been bumping into somebody at the office, right? Where that all completely gets eliminated. Number one. Number two is, and I know Eric's talked about this before, just how corporations over the last 25 years have continued to try and get more and more people in less and less space to maximize profit. I did the same thing when I was running Intero. I had a goal initially when I took over as CEO in 2014 to get Intero under 150 square feet per agent. And then when I left, I got it under 150 square feet per agent. My goal was to get it under 100 square feet per agent, because I knew if I got it under 100 square feet per agent, I could make the most money humanly possible for Warren Buffett, Berkshire Hathaway, and all their investors, right? Well, that's now all out the door, right? So, the days of, maybe it used to be 400 or 500 square feet per employee back in, the 80s and 90s. It went to, 100 to 150 square feet per employee. Even if that goes to 250 square feet employee, which they're going to have to do, they're going to have to give more space. There's going to have to be more open space in the areas. Even if 50% of the workforce worked at home full time, you're still going to have an office supply shortage.
Tom, right now in Silicon Valley, Urban Catalyst, we are an essential business, and we follow the Santa Clara County guidelines to reopen our business. And we have a minimum workers per square foot of 250.
There you go.
That's what we're utilizing right now.
And I don't know, I think you quoted it, the number, Eric, but I want to say Google or so, they're down around 150, 160, 170 square feet per employee, right?
They are. We talk a lot about this because a lot of our potential investors and our current investors want to know what is happening with the office market, because the Urban Catalyst story of doing ground up development in downtown San Jose, a lot of that is driven by the migration of the large tech companies as they've been utilizing their, what we call a decentralized headquarters strategy, trying to put their office space closer to where their employees live. Because it's so expensive to live in Palo Alto. It's less expensive to live in San Jose, but you might commute for an hour and a half, each way during rush hour.
Right.
So we've seen these big tech companies moving southward. Now, if, of course, everybody was going to work from home forever, that would be a big problem for us here at Urban Catalyst. Now, probably important to point out, we only have about 25% of our portfolio is office. We have a very diversified portfolio of asset classes. And COVID's only been going on for about 4 months now. And it's hard to be able to tell the future. How much is this working from home going to be offset by additional space required, for social distancing? But it does seem like right now we're reaching that equilibrium where people that are coming back to the office, you're only able to utilize as much space as you have.
Yep.
We have about 50% of our employees coming in right now, and I wish it was more. I wish we had more office space so we could bring back more. So here at Urban Catalyst, we want to see more.
Yeah.
When we listen to,
I think it's as much as I know a lot of people would like to think that they could avoid the hour and a half commute to work and work from home for the rest of their life, the reality of it is that just doesn't make sense to me. There's just too much productivity, too much idea sharing, that's going to be lost, and it's just a lot of it's the hallway talk, it's the coffee talk. I mean, that's where a lot of big ideas, great relationships are created, and you're just not going to do that through Zoom. I'm sorry.
Yeah, that's exactly what Eric Schmid from Google said about Google's plans. Google's planning on coming back to the office 100%. And he said, our moonshots are created. The ideas for those, they come up with them around the water coolers. It isn't about figuring it out over Zoom.
Right. Well, and hence that's the reason why, they built the kind of spaces that they did, they want everybody together all the time because they really do know. I mean, all the companies do. Apple, Google, everybody, they know. I really don't care what they're saying right now. I think they all recognize that the culture of their companies and the ideas that get created as a result of them spending so much time together is irreplaceable, and they're going to have to do it. But that being said, do I think the future is going to look different than it did pre-COVID? Certainly. I think there's going to be a lot of people probably working from home, at least working home from part-time. There's going to be maybe more flexibility, but, as I think I've shared before, everybody always overreacts when there's a jolt, and it doesn't matter whether it was the earthquake of '89, whether it was a dot-com bust, if it was, the Great Recession, your initial reaction is kind of just panic and fear, right? But I think, as things kind of start to go back to normal, and you can already see it now, how much people are going crazy to get out and socialize and connect and be together. And I can tell you, I spend quite a bit of time up in my home here in Tahoe, as much as I do down in the Valley. Up here, it's as busy and people together as I've ever seen. Yes, there's occasional masks and all of that, but that's people from the Silicon Valley coming up here because they want to be together and they don't feel like they can do it down there. So eventually, I think you're going to find it loosening back up. Certainly everyone's going to wash their hands more, cover their mouths when they sneeze, be respectful of everybody else's spaces. There's going to be some significant changes like that are going to happen over time. But I think you're going to find, as has happened in most of the other big crises, even September 11th, right? Who would have thought you'd be back on an airplane again? Or who thought you'd be whoever thought they would build another high rise in New York City, after all of that, but, when people kind of the reaction of that short-term anxiety, fear wears off, then kind of rationality sets back in, and you start to just plot forward. And I think we're going to kind of get back there with some significant changes, but probably not nearly as significant as what most people think. I think in a year or two, once they have vaccines and therapies and everything else, I think I think the economy is going to go crazy when that happens, because I think there's going to be so much pent up demand for everything. Now, can the restaurants and the clothing stores and the retailers all survive that long? That's a whole other question. But, at the other end of that, you got to imagine that, if Tahoe's any indication of what's going to happen when people can kind of take the handcuffs off, that's what I see happening.
An interesting thing, because I'm looking here at your slide that says San Jose will recover.
Yeah.
San Jose was recently featured in Bloomberg as what Bloomberg sees as the first city to recover from the COVID pandemic across the country. And it's funny that they use the word recover, because here in downtown San Jose 3 weeks ago, 2 of the high-rise buildings sold.
Yeah, you were just telling me.
Yeah, they set record prices. So that's a multifamily building and an office building, set record per square foot prices. I'm bullish on downtown San Jose as a place, not only to own real estate, but to do ground up development. But I don't think I could have predicted that we were going to set record pricing for sales in the middle of a pandemic.
I couldn't either. Well, again, you look at San Jose. San Jose in many ways is kind of the top of the funnel, for people coming in from the East Bay, people coming in from the South Bay. It's really the top of the funnel, then back up to the peninsula, right? So it's really kind of the linchpin that pulls it all together, pulls the peninsula, the East Bay, and the South Bay. That's the hub. That's, and it's, like anything, it's always painful getting it to the point where you want it to be. But I'm in agreement with you, and especially, for the Bay Area and Silicon Valley to take that next step, to be able to get transportation, rapid transportation, mass transit. That's going to be a huge impetus, I think, for what the future has in store personally.
So, with that, Tom, I'm going to talk a little bit about Urban Catalyst and our Opportunity Zone Fund and what we're doing in downtown San Jose. And be sure to ask me any questions you might have as I go along about any of our projects, or give me your insight as to how you feel about some of the different asset classes that we're building.
Sure.
So I'll start off talking about Urban Catalyst, really what makes us different than a lot of other Opportunity Zone funds across the country is most other Opportunity Zone funds, their basis is they're raising a tax advantage fund. Their plan is they're going to go out, raise $1 billion, and then find developers that have projects in opportunity zones across the country. Here at Urban Catalyst, we look at Steve Jobs and Steve Wozniak, here we are in Silicon Valley, and we think, did these guys go out and raise a bunch of money and then hire someone to build them a computer? And the answer is no, they built a computer and then they took it out to market. And that's exactly what we're doing here at Urban Catalyst. We are not just fund managers, but we're also the developers of all 7 of our projects. And we have 7 projects in our portfolio. And now that we have those projects, we're taking those projects out to market to finance them. We were talking just a minute ago about downtown San Jose, how it is the hub of all of these, different parts of the Bay Area, the East Bay, the Peninsula. A lot of people don't know San Jose is the 10th largest city in America with over 1 million people. And when I formed Urban Catalyst, my plan was to start a great real estate equity company, doing a lot of the things that Tom talked about, culture, ideas for success. And I wanted to focus in downtown San Jose because that's where I saw the light switch turn on for ground up development about 2.5 years ago. And it was really the migration of these large tech companies and just the overall macroeconomic environment in Silicon Valley that was pointing towards development here. And it was only after that that I learned about the Opportunity Zone program, and specifically that almost all of downtown San Jose was covered by opportunity zones, as you can see in this picture. One other thing I should just point out, which is important for folks that are interested in investing into opportunity zones. I mean, if you've had a capital gains event in the last 180 days, which is typically the sale of real estate, the sale of a business, or the sale of stock, you might be an opportunity zone fund investor. And if you are, what you really need to think about when looking at opportunity zone funds is what are the projects that they have in their portfolio? Because the biggest benefit you get for investing into an opportunity zone fund from a tax perspective is after 10 years, you're able to get tax-free profits. There better be profits after 10 years in order to get tax-free profits, or really what's the point of the entire program? So when we think of how we structured Urban Catalyst, we are a solid fundamental real estate equity fund. We have great projects in our portfolio. We have an experienced team of developers that have a track record, because previous experience and track record is, of course, the best indicator of future success. And, I showed that map of downtown San Jose earlier. What I didn't show you was these blue areas. These are Urban Catalyst projects. So we've acquired 7 projects in the downtown area. I mentioned that we have a diverse portfolio of assets here in the Diridon Station area, and this is literally 500 yards away from Google's future mega campus. This is an extended stay business hotel. It's a Marriott Town Place Suites. This is an apartment building. This is a senior living facility. It's assisted living and memory care. Here in the downtown core, we have 2 office projects. This is a high-rise residential project right next to the BART station and City Hall. And then over here next to San Jose State, we have a student housing high-rise. So when I say I think a lot about these different asset classes, how they're affected by the pandemic, which ones are good now and which ones are good later, I do a lot of thought about it. And it's one of the reasons why you have a diversified portfolio of projects. As you can see, here are 7 projects. You want to make sure that you're always able to survive things just like this pandemic. So, Tom and I were just talking about how the 2 high-rise office building, or the high-rise office building and high-rise multifamily building that sold recently for record prices, 10 years from now, we're planning on selling all of our assets and returning all of those profits to our investors. If we were having the same thing happen to us 10 years from now that's happening right now, how would we look? And the answer would be, well, we have a lot of residential projects. The Icon's a residential project. Madera is a residential project. The Mark is residential. It's student housing. Delma Senior Living is residential. So our residential portfolio should be fine. Record office pricing. Our office price will be fine. The one thing that we might have a problem with is our extended stay business hotel. And yeah, hotels have been hit harder than almost any other asset class during COVID, maybe besides retail. Retail is really probably taking the brunt of it. I think the silver lining for us with this hotel, extended stay business hotel, our typical person stays for 15 days and every single room has its own kitchen. Extended stay business hotels have done slightly better than other hotels, during the downturn, just because of how they operate. It's not like we're a luxury vacation hotel, right? So we have the ability to, if it was 10 years from now, we would sell most of our assets, but we could hold the hotel for a year or two to do whatever we need to do to maximize the value to our investors. And what I think overall, the point of a diversified portfolio is just that. Who knows where we're going to be 10 years from now? Are we going to have a hard time with office? Are we going to have a hard time with student housing? There might be one of these assets that has a problem, but the majority of them should be not just okay, but amazing. I don't know, Tom, what do you think about some of the different asset classes and how they're impacted by COVID here in the downtown area?
Well, I mean, certainly what you said, hotels, retail, restaurants, I mean, all of that's, I mean, I don't know. I mean, that's you don't know what that's gonna be like here in the near future. But again, people are gonna go to restaurants again. People are gonna stay at hotels again. And people are gonna be going to shops again. So I mean, again, certainly I think things will look different. But I don't think they're gonna look as crazy different as most people think they are gonna look compared to what they were pre-COVID. I think if you go out. By the time we sell these things in 10 years from now, COVID's going to be ancient history. It's just kind of a fact, right? Hate to say September 11th was the same way. Now it's a date in history, an important date in history, but people aren't making decisions based upon what happened then, and that's kind of how it's going to go. I will chime in just one other, comment, and I don't know if we even had a slide on this or not, Angela, was, why did I invest in Urban Catalyst, and what are some of the other, reasons why, investing, not only within opportunity zones, but Urban Catalyst specifically, was, you get so many benefits. Number one, you do get the benefit of, there's profit to be made in building a project. That's why I'm a developer, right? Because I can make money by buying the land and building the building. So basically, as Eric had said, a lot of these opportunity zone, funds, what they're doing is going out and buying existing buildings, trying to retrofit them, do whatever they need to do to make them compliant with the opportunity zone requirements, but they're probably not getting the bang for the buck that you get from putting something straight out of the ground, like what you guys are doing. So when you get the combination of location, San Jose, Silicon Valley, I mean, I can't think of a better place to be putting your capital than that. You take into consideration the tax benefits that come along with being an opportunity zone fund. You take into consideration the fact that you bought these lots and are building them from the ground up. So you're going to get that additional appreciation that comes, the additional return on your investment that comes from building something straight out of the ground. And then, as I talked about early on, I mean, the team that they have at Urban Catalyst, and I will tell you, as I didn't know these guys, I don't even know when I invested. I think I invested at the end of last year, and I just stumbled along Urban Catalyst because somebody who I knew and respected was trying to help me out with a building that I owned in downtown San Jose. And they basically told me that, look, if you need help with anything in development in downtown San Jose, you have to talk to Eric and Josh. And that was my initial introduction to these guys, was not to be an investor. They just offered to help me out trying to figure out this piece of property I owned in San Jose. And then the more that I learned, not only about their projects and the fact that it was an opportunity zone, but also, and not only just the people they have as partners on their team, but their board, the advisors, the people that they have on their team are really second to none in the industry, especially when you talk about Bay Area and Silicon Valley real estate. They've got just a phenomenal foundation of people with a tremendous amount of experience, on how to weather storms and, come out the other end of it incredibly successful. So just in a nutshell, that's why I did it, and I did have a capital gains event. So I did roll in my capital gains into it. And, I'm optimistic.
Tom, I think that's a pretty good segue because, when we talk to a lot of our investors, what they really want to know is if they invest with Urban Catalyst, when do they get money back? How does that whole process work? Because most people, when they've heard of opportunity zone funds, they just hear about that 10-year period and they think, boy, if I'm investing my money now, am I going to have to wait 10 years to get my money back? And the answer is no. And let me kind of go through that a little bit. And I'll talk about that value add, boost that you get by doing ground up development. So we're raising money here at Urban Catalyst for this fund in 2019 and 2020. The fund closes on the 30th of December this year. I mentioned today we've raised around 65 million. Our plan is to raise between 125 and 135 million by the end of this year. The first time that we give money back to our investors is through our refinance and distribution program, and that starts in 2023. And let me,
Eric, just because I know you may have some people that are on this call that aren't super savvy real estate investors, I think, explaining to them a little bit about how you go about, once these buildings get built, you get them occupied, and how that whole restructuring and debt works and how you're able to get them their money back. You always say, but I think the mechanics of it will help people become a little bit more comfortable with how that process works.
Absolutely, Tom. So the way that it works is we build our buildings.
With construction financing?
Yeah, we get construction financing, we build our buildings. The whole point of ground up development is that we have to have the ability to build a building for a better price than we could just go out and buy an existing building. So that's the whole beauty of ground up development, is you build it for a certain price, and the day that it's occupied, it's worth significantly more. And that is the value add. So we go out, we build our buildings, we lease them up, they stabilize, then we go out and we get permanent financing. We take that permanent financing, we pay off the construction loans that we use to build the buildings in the first place, and then any excess refinance proceeds, we distribute those to our investors tax-free. And right now, we're targeting distributing 80% of our investors' initial investment back to them through this program between 2023 and 2026 as our projects come online.
And so Eric, as you kind of go through that, obviously not all the buildings are going to be done at once. They're all going to kind of be at different phases. So you're just restructuring the debt on each one of these buildings as they're completed and getting filled up, correct? And that's going to be a 4-year window on your map there, because it's all not going to happen on one day. It's going to gradually happen over a period of time.
That's absolutely right. Our first smaller projects like our Paseo project, that stabilizes in 2023. Our larger project like our high rises, they just take a little bit longer to build and a little bit longer to lease. And so that's 2026.
Yeah. I think that's, I know for a couple of my investor friends that have come in, that was just that aren't familiar with real estate development, restructuring debt, and all those types of things. I think that was hopefully helpful for some of your listeners.
I hope so. You know, it's really just real estate development 101, which is you build a building, you lease it up, and you refinance it, and you pay off the construction loan. I mean, that is what we do every day, what we've done on every project throughout our whole career. You're right. So sometimes I do forget because it seems like it's what I do all day long. So I'm glad you talk
well,
about
it. It's like me, you know, it's like me in venture capital now a little bit, right? It's like, don't use acronyms. I can only search for words so fast on Google that are coming out of your mouth that I don't understand what you're saying.
All right. So, you know, opportunity zone funds themselves are interesting because, you know, typically in a real estate equity fund, we would sell the buildings maybe after 5 or 7 years to maximize our investors' returns. But because we have to wait to the 10-year mark to get those tax-free profits, it really creates almost a hybrid type of a fund. Here in the first 5 years, we're a value add fund and we're creating value through ground up development. In the second 5 years, we're more of a core fund where we have stabilized assets that are cash flowing. And we'll be passing that cash flow through to our investors in the second 5 years. And one important thing, Tom, I always like to point out is typically when you own real estate, you depreciate your assets, and that's something you do with the IRS. And we're going to be doing it here at Urban Catalyst too. Because we're structured as a partnership, we're able to pass through depreciation to our investors. Because we're anticipating having more depreciation than cash flow in the second 5 years, that would make all of the cash flow that our investors receive tax-free. Finally, after 10 years, we plan on liquidating the fund, selling all of our projects, and returning all of the profits to our investors. You know, that's really the big win for our investors. And one last thing, and this may be a little bit too real estate-y, but important to point out because it is an important benefit of the program, is, you know, I talked about taking that depreciation on the buildings. Typically, when you sell a building, you have to pay back that depreciation to the government. Specifically for opportunity zone funds, as a part of the December 2019 final guidelines from the Treasury and the IRS, we do not have to pay back that depreciation. There is no depreciation recapture. And that's a huge benefit to our investors. I thought when that came out, it was going to be front page of the Wall Street Journal, but it really wasn't reported very broadly. So I wanted to make sure I pointed that out.
Well, and look, I'll tell you too, being a real estate investor, developer, you know, that is always one of the biggest challenges when you own real estate, is how to get out of it without having a massive tax implication that's just going to take out all your profits, right? And so that's the other nice thing is you own a piece of real estate, and then you get, you know, all of your gain tax free, which means you don't need to do a 1031 exchange into another piece of property. Because what a lot of real estate developers do is they're paper rich and cash poor, you know, because they never can sell anything because the tax implications are so significant at the end of one of these deals. Where with this one, there's no downside to you as an investor or us as investors in selling the asset after 10 years, because basically all the gains tax free as long as you used your capital gains as your original investment.
That what a nice way to put it, Tom.
Well, and so the other thing I would just point out, and I'm assuming, Eric, you know, with everybody you've got on here, you've probably had some conversations with them already, you know, about the, you know, obviously, you know, if you have a capital gain tax event right now, you're going to owe that tax still, you know, and the goal would be that you're going to do your distribution with the restructuring of the debt in order to give them the capital to pay that tax in 7 years. Even though it's significantly less. I don't know if everybody kind of understands that or not on the call, but.
You know, I wanted to go through and talk a lot about real estate on this webinar, but I will point out the three major advantages, tax advantages of investing into an opportunity zone fund. The first is you're able to defer paying capital gains taxes on that capital gains event if you invest into an opportunity zone fund within 180 days of that event. You're able to defer paying those taxes until 2027. So that's right here, April 2027. You still have to pay the capital gains taxes, but you get to defer them for 6 years. Now, one additional benefit you get is when you pay your taxes in 2027, you get a 10% discount. So for every $100 you would have owed in taxes, you only have to pay $90. But to your point, Tom, here at Urban Catalyst, we're planning on distributing 80% of our investors' initial investment back to them prior to 2027. Now,
Right.
that's more than enough to pay your capital gains taxes in 2027. And even if we run into a bumpy economy or we have issues with any of our projects, we still more than likely will be able to distribute 25%, which is still enough to pay your capital gains taxes. It's a lot less than 80%, but yeah, you can still pay taxes.
Yeah. No, I mean, I think that's and again, that seems to me when I talk to people that whole first, up through 2027, that whole process of your capital gains, investing it, and when taxes are due, and how much is paid, and how am I going to pay it, is the hard part for a lot of just people that, haven't really studied this to kind of wrap their head around. So, at the end of the day, the nice part is, you put your money in, you're going to get your capital back to pay your taxes, and you don't get diluted in your ownership percentage of the building. Granted, you're going to have more debt on the building that they're going to have distributed to you, but your ownership percentage isn't going to get diluted. So you still get the nice big gain at the end as well.
So with that, we probably should open this up to Q&A, and I will turn it over to Angela to moderate our question and answers.
Thank you, Eric, and thank you, Tom. We did get quite a few questions. One is, we've been talking a lot about companies and workers working remote, but do you think that that move to remote work, how is that going to affect investors investing into Urban Catalyst, fund with residential and commercial and office properties that we have?
Sure. So I'll start off answering that one. I mean, overall, each of our different asset classes there are different demand drivers for each one. Residential in general, here in Silicon Valley, we have a housing crisis. And that's because we've created 5 jobs for every housing unit that we've built for over 35 years. And that trend is increasing, not decreasing. So when we look at building residential, we really just can't build it fast enough. Student housing, that demand is driven by San Jose State. It's really been San Jose State's been undergoing a transformation in the last 10 years, becoming more of call it a destination school. It used to really be a commuter school. And in that time, San Jose State hasn't done as good of a job of building student housing to meet the demand. I mean, when you get accepted to San Jose State now, students move to San Jose to attend college. And their own internal studies show they need roughly 6,000 student housing beds. We're building 800. 1,000 just came online. But that still is just taking a dent out of the overall demand. And to give a better example of just how intense that demand is getting, there was a survey of San Jose State students last year, and 13% responded saying that they had experienced homelessness in the previous 12 months. And to combat that, the university now has parking lots on campus designated for students to sleep in their cars. Wow. And they have a security guard that watches them at night to make sure that they're safe. So yeah, it's a huge demand for student housing. I think we've really covered, Tom, office and what we feel about office. And we talked a lot about hotels already and what drives that demand, but maybe I should talk a little bit about our assisted living memory care facility. Overall, that's the type of facility, it isn't a choice when folks move into that type of facility. It's because they have to. They need that extra assisted nursing care. They need the memory care. So that's really a recession-resistant type of facility. And right now, if you live in one of the surrounding neighborhoods and you wanted to put your parents or your grandparents into a facility like that, you're looking at a 6 to 12 month waiting list. And that might be for a place that is half an hour to an hour drive away. So there's a huge amount of demand for senior living. They just haven't built a facility like that in downtown San Jose in over 35 years.
This is an interesting one. Which project is expected to do best and which is subject to bigger risk in a portfolio?
Boy, that is a very complicated answer, Angela, but I could say it like this. I mean, each project has its own risk profile. And the way that we acquire land to determine what type of projects to build on certain properties is so that we can minimize that overall risk. A good example is that senior living facility. That facility, it takes 3 years in general to fully lease up all of our units. That's what we anticipated. Just that is how the flow of people come in. So it takes longer to lease up, but when it is operational, you get a lot of cash flow out of it. However, it's very intensive from a management perspective. Now, we work with an operator. We don't manage it ourselves. And we've done 6 of those facilities in the past, so we're really familiar with how to design and operate them, utilizing our third-party management services. But, the point of it is that those types of facilities, because of the increased issues associated with managing them, they have a higher cap rate. So when you sell them, you don't get as much value out of them. Now, office is like the opposite. Residential or multifamily is like the opposite. Multifamily, because here in Silicon Valley, Class A multifamily is the greatest thing you could ever own, because it's going to be 100% leased forever, and everyone knows it. It's not like you're doing business in Texas and you don't know that other developers might be building 1,000 units right next door to you in the next 5 years, because it's easy to build ground up projects. It's almost impossible to build ground up projects in California. We're never going to be able to build enough housing to meet the demand. And so that type of project, we lease it up relatively quickly. However, when we sell it, we just get a huge bang from our buck because it is a very, very low cap rate. So all of this combined with how we end up financing each individual project, how much money we end up putting into each project to balance our overall portfolio from a diversification and a risk mitigation strategy. So I guess a long answer to a question, but hopefully our listeners got some benefit out of it.
That's great. Thank you, Eric. It looks like we're out of time, and we have some specific questions that were being asked. So we'll be sure to address them individually after the webinar. But thank you again very much, Tom. It was really great for you to join us for this engaging conversation, and we appreciate everyone joining this webinar. And if you have any questions, and if you would like to find out more about our portfolio, please visit us at urbancatalyst.com.